If your rental is making $300 a month, you don't own an asset. You own a job, and a low-paying one at that. Today, I'm breaking down the 3 types of rentals that will actually build real wealth. Not just cash flow, not just appreciation, but real wealth. I'm talking about the kind of rentals that change your tax bracket. And I promise you this, most investors are buying the wrong type. By the end of this video, you will know which rental makes the most cash flow, which rental makes you the most equity, which rental makes you financially untouchable, and which one the beginners completely misunderstand. Stay till the end, because the third kind is what wealthy investors quietly build while everyone else chases trendy garbage. Let's get into it. Hey everyone. If you don't know me and are new to my channel, my name is Vikram Chopra. I'm an investment banker and a realtor in the Charlotte metropolitan area, where I invest and help other investors reach their financial goals. Section 1. The cash flow machine. Small multifamilies, 2 to 10 units. If you want predictable, controllable income, small multifamily is the king. I'm talking about duplex, triplex, quads, all the way up to 10 units. Not a 200-unit apartment complex, that's way too much. Not a luxury tower, small, boring buildings. And boring makes you rich. You'll find that these are frequently located in or around the edges of a high-density metropolitan area, just like Charlotte. Often found in older established residential areas mixed with single-family homes. Other areas to look for this type of asset class is near transit areas. You will definitely not find these type of asset classes where the median home price is over $1 million. And of course, the best option is to know property managers who manage such properties in your area. If the owner intends to offload this asset from his portfolio, he or she will definitely tell the property manager. And if you're friends with a good property manager, there's a good chance that he'll call you. So it's good to know people like me. You never know. But why is it that small multifamily always wins? Why? Here's the math that most beginners ignore. If you own one single family rental and the tenant leaves, your income goes down to 0. If you own a fourplex and one tenant leaves, you still have 75% occupancy, and that should cover your mortgage. Big difference. Vacancy rate drops immediately from 0% to 75% if you have a fourplex. And wealth is about reducing risk and increasing leverage. If one unit turns over, you are not panicking about covering the entire mortgage. The property keeps producing income while you fix the issues. More predictability, less volatility. One tenant, 100% risk. 4 tenants, leverage. That's what we want. Forced appreciation is the biggest concept when it comes to multifamilies. This is where it gets really interesting. In most markets, including the ones in and around Charlotte, small multifamilies generate higher rent per dollar invested, have stronger cap rates, support better debt coverage. Single-family homes, on the other hand, are often driven by owner-occupied tenants. Multifamily is valued more on income. Income-based valuation equals opportunities for investors like you and me. Single-family homes are priced based on comparable sales, and that could change depending on the market conditions. But small multifamily, they are based on incomes. You calculate the cap rate when you're trying to buy a multifamily house or building. So you take the market conditions, the unpredictability out of the equation. Instead, you're just doing the maths to calculate what you should pay to get this or buy this multifamily asset. And if you raise rents, you're forcing appreciation. Let's say you have a fourplex and you increase the rent by $200 every month for each tenant. That's $800 a month. That's $9,600 in the entire year. At a 6% cap rate, you just increase the value of your asset by $200,000. That's not hypothetical. That is math, pure maths. And there are hundreds of ways to increase rent in a small multifamily asset class. And there are so many easy ways to increase the rent. You could modernize the kitchens, you could modernize the bathrooms, you could change the flooring, put LVPs, you could upgrade the lighting, you could enhance the curb appeal, some landscaping, some parking lot repairs, everything to justify a higher than market rate rent. Introduce high demand features like in-building laundry, internet access, bicycle racks, secure modern access systems with the keys and not the manual keys. And of course, the best and the easiest way is to pass the utility cost back to the tenants. You as an owner, as an investor, should not be paying for water, sewer, trash. No, let the tenants pay for all of that. You increase your net operating income without spending even a single dollar on any large capital investments. See, once you own an asset class of this kind, a multifamily of 4, 6, 8 units, you will find ways to increase the rent and reduce your expenses. That is given. You're smart enough to do that on your own. That begs us to the next question. Who should buy a small multifamily unit? Who? Investors like you and me who want predictable income. Not 20 homes spread across the entire town. You cannot scale faster if you have a single family home. Even if you have 10 single family homes and they are all over town, you cannot scale it as fast as you can do that with a multifamily asset class. If I was starting over with $80,000, $150,000, this is where I would put all my money in. Not some sexy Airbnb, not some special creative financing, a fourplex in a solid B-class area. That's where I would start. In fact, this is my plan too. I own homes all over town and I don't like it. It is troubling me. I have to drive, I have to sit in traffic to go from one home to other all over town and I don't like it. Charlotte is growing so fast that the infrastructure, the roads are not able to keep up. So going anywhere in the evening takes an hour, even if it's like 5 miles away. It's a lot of wasted time and resources. So if anyone wants to sell their fourplex and they are in Charlotte, send me the details below in the comments and I'll buy it. And then what are the mistakes that people make when they are trying to buy a fourplex? They underwrite it like a single family home, which it is not. You don't buy it because it's cute. You buy it because the numbers dominate. If it doesn't cash flow, after you account for all the different aspects like reserves, you take into consideration vacancies, you take into consideration maintenance issues, after you budget for capex items, well then you know what to do. You walk away, you run, you don't care, you don't want to buy. In all business negotiations, you should always be willing to walk away. We travel all over the world. So when we go to the Middle East, when we go to Dubai, when we go to Morocco or other places, if the shopkeeper says this is $5, I don't pay $5. I'm going to negotiate. I'll try to see if I can get it for $3. That's what it is. It doesn't matter if it's a small item or a big multifamily home. And how do you check if the asset is worth buying it? You calculate the cap rate of that multifamily home that you're trying to buy. I generally don't want to buy anything that's less than 8% on the cap. To calculate the cap, divide the net operating income by the sale price, multiply that by 100, and that's your cap rate. And you better make sure that number is more than 8%. Otherwise, adios. I'm not buying that. I'm out of here. And to calculate the net operating income, just make sure you subtract all expenses out of the gross rent that you're getting. A few years ago, I was trying to buy one of these buildings here in Charlotte. It was advertised that the building cap rate is 9%. Now, when I saw 9%, it's more than 8%. I wanted to invest. I wanted to check it out. I was very excited. It's not very often that you find an asset class like multifamily where a cap is more than 6%. And this guy was advertising as at 9. Of course, this is Charlotte. It's not easy to find something like this in this market. So over the weekend, I sat down, I took a glass of water, I took down all the numbers and I started crunching them up to see what comes out. And then I realized the agent had provided incorrect information. He was trying to fake the numbers that would give a boost to the cap and people would fall for it. The actual cap rate was close to 4%. I was so mad. I was stomping on the carpet. I was kicking the cat. I was really mad at him, really mad. And then I called him and asked him some questions around the numbers. And then he goes, oh, I have to check with the seller and the office manager about those numbers. Like, what the hell, man? I was livid. I obviously didn't buy the asset, but I wasted more than a week or 2 weeks. I also learned a valuable lesson. Do the maths yourself. Don't believe in what everyone else is saying. People lie when it comes to making money, and I hate it, but I don't operate that way. Emotion is expensive, and this is true even if you are negotiating your salary with your HR manager at your office. I always give a very high number when I'm negotiating with the HR team. I tell them, I don't want to negotiate. I have the skill set that you're looking for, and I want this much. Period. And then I zip up my mouth and I sit quietly. Whoever opens their mouth next loses, and I'm not there to lose. I just shut my mouth and sit there tight. I'll be honest with you, I've lost jobs, I've lost investment properties, because I was not willing to negotiate below the number that I had in my mind. I was not willing to pay more or accept less salary at work. By doing all this, I won't have stress later on down the road. Yes, we all get very disappointed when we lose out on a deal, but it's always better to have a decent deal than a bad deal, because if you buy a property that is not worth that much, then it's going to be painful for you throughout the ownership of that property of yours. Here's a reality check. Small multifamilies will not make you famous, go viral on YouTube, impress your friends, no. But it will quietly build you $5,000, $10,000, $20,000 a month. That, my friend, is financial independence. That is what we all seek. Of course, you won't be spending that money on your leisure travel trips to Singapore. You'll find ways to improve the property, and then in turn find ways to increase the rent, because now you spent money on it. And when you think there's no more room of improvements, there's no more room left for increasing the rent, there's no more expenses that you have to pay from your pocket, what do? You move on to the next fourplex that you plan to buy. Section 2, the equity accelerator. Single family homes in growth markets only. Now let's talk about the most misunderstood wealth builder, single family rentals. Everyone loves to hate them. Cash flow sucks, too much maintenance, not scalable. Wrong. If you buy them correctly, they are equity rockets. Where does this work? Not in declining towns. You buy them in growth corridors. For example, areas outside of Charlotte, suburbs near Raleigh, expansion zones around Nashville, tech-influenced metros like Austin. You want population growth, job growth, infrastructure investment, school demands. You ride the wave, my friend. And you know what? The most overlooked part of a single family home is the yard. Most investors think yard is a pain. I don't think like that. If there's a yard, there's always a tussle between the owner and the tenant about the upkeep of the yard. The tenant won't care to cut the grass, and the HOA will be quick to send a letter to the owner, that is you. So what do? We eliminate this problem itself. In this case, we eliminate the yard. We build an accessory dwelling unit, ADU, on it. For smaller yards, it could just be a one-bedroom ADU. And that's where the magic lies. Rent out the ADU, no yard, no complaints, no drama. And now you're making an additional income on top of it. All of this adds to your cash flow. And ADUs are legal in most states. Just check with the local zoning laws and just use the mapping tools to make sure that the property allows an ADU to be built on top of it. Also, about the cost of the ADU, you have to be extremely careful about it. You have to keep your budget tight. No room for budget spill. For example, when you're trying to put in the lights, there's no need for expensive chandeliers. Just simple LED lights will do the job. They are equally efficient and much cheaper. Just make sure that the ADU is built within the budget that you have. More things that you can do with your single family home is isolate the basement. If you have a bathroom in the basement, you've already won 60% of the battle. Just make sure that the basement has a separate entrance, and voila, close the basement entrance from the house and just make one entrance to the basement from the outside. Now you have a single family home and an additional basement that can be rented out to a different set of tenants. Just make sure that the utilities are separate and there are no more complaints now. Why does this method make you rich? Cash flow keeps you alive. Appreciation makes you wealthy. Let's say you buy a $350,000 house. You put 20% down, that's $70,000. If the home appreciates 5% annually in year one, you have an equity gain of $17,500. That's a 25% return on your $70,000 cash down payment. And that also before the rent pay down. Appreciation is silent, but it's violent. The power of 10 houses. One house won't change your life, 10 will. Because loan pay down compounds, appreciation compounds, rents rise, tax benefits never end. After 10 to 15 years, you're probably sitting on millions in equity. Most people quit at 2, that's why they stay average. But you, my investor friends, are not average, and neither am I. So tell me more about how many properties you own in the comments below, how much equity is in them, and I'll be more than delighted to read those. In fact, I'll be inspired. Now, the next question is, who should buy these single family homes? High income earners, people who can qualify for loans, long-term thinkers, anyone who wants to retire on paid off assets. If you are in your 30s or 40s, this is your 15 years domination plan. Of course, this goes without saying that you have an excellent credit score and you're on top of your expenses. You're not living paycheck to paycheck. You're on a tight ship. Long ago, I knew someone who inherited 4 homes that were not paid off. He was not a high income earner and he was not very smart also. He couldn't pay off these homes. He couldn't sustain these homes and he had to foreclose all 4 of them. There will be expenses in all of the homes that you own. Until the time that the homes are less than 30% leveraged, it is a hike. So keep that in mind. Buying a home doesn't just solve the problem. Managing and maintaining those homes is the real challenge. So what should be a key strategy? Buy slightly under the market price. Cosmetic value adds to the property price. Refinance later once the appreciation has happened, and then refinance again and again and again. You don't need 100 deals. You just need 8 to 15 great deals. Section 3, the wealth multiplier. That is the short-term and the mid-term rental. Now we are getting controversial, because that's Airbnb and short-term rentals and mid-term furnished rentals. Some people crush it, some people get destroyed. Now this works in markets like Miami, Myrtle Beach, Las Vegas, Los Angeles, New York, and other mega metropolitans where the tourist footfalls is immense. And here's the truth, when done strategically, this will print money for you. And by strategic, I mean you live there physically next to your asset, or at least in close proximity to the asset, not very far away, not in the neighboring county, not in the neighboring city, not in the neighboring state, but very close to your asset. Many of you who work in the tech industry know what I mean. The manager these days want to know where you live physically. You want to see the driver's license even before conducting an interview. How about the short-term rentals? You buy in tourist areas, corporate hubs, near hospital, and in high-demand areas. You furnish these assets of yours and operate it like a business, a hospitality business. And your monthly cash flow can be 2 to 3 times the rent. But here's the catch, it's not passive. It's hospitality. You have to be involved in it day in and day out. Short-term rental is not real estate. It is a hotel business. Mid-term rentals. This is the quiet killer. 30 to 90 days of furnished stays. Think travel nurses, corporate relocations, insurance placements. More stable than Airbnb, higher rental incomes compared to other long-term business models. Less regulation risk, and this is where the smart investors are moving towards now. So why does this make people rich? Because it increases the yield. Higher yield equal higher capital recycling. You recover your down payment faster and then you put it back in. And then you buy again and again and again. Really awesome, isn't it? Why is it then all of us are not super rich, including me? Because when not done correctly, someone else will become super rich and you will stay broke. Property managers charge up to 40% of the gross rent for short-term and mid-term rentals. That is before you pay any expense, even a single dollar out. And when it's tourist season, your eyes will pop out when you see how much the tourist is paying to stay in your house, and your eyes will fall off the socket when you see how much money you have in your hand. Property managers charge 40 to 50% of the gross rent. From what's left, you have to pay mortgage, taxes, HOA, all of which increases every year because Uncle Sam wants his share too, and all the other expenses in the middle. That's why I mentioned earlier, you need to stay in close proximity to your asset so that the 40 to 50% that the property manager pockets, you get to keep that big share, that big chunk of money. Now, if you're doing that, you're truly raking in the moolah. Truly. I have a friend who has 2 Airbnbs in Arlington, Virginia and in Washington, D.C. There's a metro station right next to each one of those. The metro ride from Arlington, Virginia to Washington, D.C. is less than 10 minutes. He makes close to $15,000 net every month from each of his Airbnbs. That's a lot of money, but he does not have a property manager, because if he did, the property manager would take $6,000 to $7,000 off the $15,000 that he's making. He himself stays in a penthouse in a top building right next to his Airbnbs. The software does most of the things for him, and he has contracts with cleaning companies and other contractors who just come in and do their job and then leave. You can't even imagine how much money these people make. people like him, but there are always dangers. There's never anything without danger. Markets change, regulations change, cities can ban them overnight, the economy could tank, the tariffs can kill any business. So what do? You buy in areas that allow short-term rentals, have a diversified demand that also work as long-term rentals if needed. Always have an exit strategy, always. So let's just compare all of these different models that we have went over today. Small multifamily, high cash flow, moderate appreciation, low risk, medium effort, single family growth, moderate cash flow, high appreciation, low risk, low effort, short term and medium term rentals, very high cash flow, appreciation, market based, high risk, high effort. Each has a role. The wealthy don't pick one, they stack them, and so should you and me. I'll give you the rich person formula. This is how exactly rich people do, or rather people who have become rich, that's what they do. Stage 1, build cash flow with small multi-family units, many of those. Stage 2, build equity with single family growth assets. Stage 3, accelerate the capital with high yield short term and mid term rentals. Rinse and repeat, rinse and repeat, rinse and repeat. All this takes time. It is not a get rich quick business. The most important alphabet in the real estate business, at least in my opinion, is the alphabet T. T stands for time and tenant, and you need both. You need time and you need tenant. Tenant pays you rent every month. Using that money, you are paying off your mortgage. Eventually, over the years, over time, your mortgage will be paid off, and it would be the tenant who would have paid it all for you. The other T is for time. As time goes on, your asset will appreciate. The cash flow from the tenant will keep you alive. It's like breathing oxygen. The appreciation that happens over time, year after year after year, is what is going to make you wealthy. It's going to build you wealth. So remember the T, the alphabet T. Now, the biggest lie in real estate: you don't need 100 doors. No, you don't. You need strong assets, long time horizon, discipline. That's what you need. Most broke investors chase shiny trends, zero down fantasies. No, they don't exist. No money down strategies. No. Building wealth is boring repetition with your own money. It's a reality check. Real estate is not get rich quick. Real estate is not no money down magic. Real estate is not Instagram lifestyle. Real estate is debt control, cash flow management, tax optimization, long-term positioning. If you treat it like a business, it pays you like an empire. And if you make a bad investment, it's not really the end of the world. I made a bad investment because I did not crunch the numbers the proper way. I let ego take over me. I let the devil do the talking on my behalf. I lost my head due to arrogance. And when reality hit me hard, I realized my mistake. I promised myself I'll never make these mistakes again. And I have not till date. From then on, every time I see a listing that I think I can invest in, I don't get excited. I run the numbers once, twice, and then go over the numbers again with my family. I don't want to get burnt again. As long as the numbers work, the risk is being minimized. I mean, things can still go south, but the chances of that happening are reduced drastically. The advanced strategy stack. Once you own 5 to 10 properties, use the Helco strategy. Use 1031 exchange for bigger assets. Shift equity into better performing markets. Move from labor intensive to scalable properties. You don't need to hold forever blindly. You optimize. And this is one area where I'm still working on. I have some assets that are not performing so well. I'm in the process of disposing them off. I'm also very careful about the use of Helco. If I don't need the money, I usually don't take money out of the property, even if the interest rates are very low. That's just my preference. I know people who have taken out 60 to 70% out from their property just because the interest rates were very low. They have close to $1 million sitting in the bank. Getting the money in your hand is the easy part. Utilizing that money optimally is the challenging one. If you have a solid plan of using that money optimally, then sure, go ahead and use Helco. It is awesome. But if you're planning to use that money for some investment in the future and you don't plan to use it now, then I would just not take that money out. Even if the interest rates are super low, I like to err on the side of caution. That's just me. The mindset shift. Stop asking how much cash flow does this property make. Start asking what does it look like in 15 years. That's how wealth is built. Most people watching this will do nothing. A few will buy one rental property and even fewer will build a portfolio. But the ones who understand these three categories will quietly become financially untouchable. Not flashy, not loud, just wealthy. If this helped you, subscribe. Give me a thumbs up, because next I'll break down exactly how to buy your first rental in today's high interest rate environment without getting crushed. And trust me, most investors are already getting crushed. So until next time, this is Vikram signing off. You'll find me in the greater Charlotte metropolitan area investing and helping other investors with their dreams. Until next time, good luck, goodbye, and go earn your freedom by starting in this journey using the three strategies that we went over today.